Hello, this is Dale, and thanks for coming back to allow me to teach you the very best way to trade earnings. Once again, my name is Dale Brethauer. Been trading for 35 plus years, hedge fund manager, been a guest speaker on a number of platforms, written 3 financial books, and I am currently very, very passionate about teaching others how to be a success in this very difficult market. So the strategies we want to consider are straddles, strangles, iron condors, butterflies. So let's first of all take a look at the straddle. The straddle, the short straddle, what I'm doing is I am selling both a call and a put at the money. And what I'm hoping for is that the stock does not move, the price does not move beyond this channel here. The problem with the straddle is this can be a pretty close movement. The other problem is you have unlimited risk. And I just am unwilling, as a conservative trader, I've been doing this for 35 plus years. I'm conservative, and unlimited risk just does not fit with my trading style. So the short straddle and the long straddle, we'll see later, are out. So let's take a look at the strangle. Well, a strangle, what you're doing is you're selling both the put and the call slightly out of the money. And what happens here is you get a little bit less profit, but you have a little wider range that the price can be within, but you still have unlimited risk. Even though it's flattening out a little bit, you still have that unlimited risk. So let's move on from that one. Now the butterfly, you start getting a little bit of risk management here by setting up. What you do is you're going to sell 2 at the money calls and 1 in the money and 1 out of the money call. You get a risk reward of about 1 to 1, but once again, the price range here can be pretty narrow, but you do have that protection of the wings here, so you can only lose so much. However, I believe, well, let's just take a look at the long straddle. The long straddle here, you're buying both a put and a call at the money. And what you're hoping for is that it busts through, the price busts through and moves on up. The only problem here is that most times the at the money calls and puts with upcoming earnings the premiums are very, very high due to that volatility crush, okay? And with the premiums being very high, you have to get an extraordinary move with the stock for you to become profitable. I believe the absolute best way is an iron condor. An iron condor, what you're doing is you're selling both a bull put and a bear call at the same time out of the money, usually at about a delta of 0.2. However, we're going to focus on the price move of the stocks that we're going to choose to invest in. I showed you this chart before where Google moves during earnings in the last 4 years, where it averages about 3.6, but 14 out of 16 times it moves less than 6% or 88%. That's what I need to know. That's what I need to know. Now, this is a chart showing all the trades that we made all the way back to April of 2016. This is 4 years of trades. And what I did is once I had the price a day before the earnings, And then I looked at minus 5.5% and plus 5.5% and set up my bull put and bear call accordingly. That gave me a total credit, and from there, then I go the day after earnings and I'm out. I'm out the day after earnings. Unless you're well inside that iron condor and you might want to choose to let it go through expiration. Talk about that in a second. But this gave me 13 out of 16 correct trades, or 81%. When we had total credit about $3 and total debit about $1.56, which is good. That's good. That's $1.50 in our favor, or 49%. This is what we want to do. Remember the chart I just showed you on Google, where 88% were below, moves were below 6%. Putting on an iron condor with the move at 5.5% brings in 13 out of 16 correct. We talked about the big six: Google, Amazon, Netflix, Tesla, Chipotle Mexican Grill, and Apple. These stocks are priced high, so we get good credit. So the iron condor, when we set up that iron condor, we've got excellent bear call and bull put spreads, and you combine those together, and that's the total you get if it stays within the range. If it goes out of the range, the credit actually will apply to the losses you might take if it goes out of the range. So even when it goes out of the range, if it doesn't go out too much, you can still be a winner. And the other nice thing about these six is they have decent open interest, providing great liquidity to get in and get out. Because we're getting in the day before earnings and we're getting out the day after. Unless it's well within, and we might let it go for a while. So I showed you Google. So here's Amazon. See, Amazon had an average move of 4.1%. It has a little bit more of a bigger range. And with Google, I was looking at 5.5%. Actually, 6% gave me 88% correct. For Amazon, that 6% is 12 out of 16, or 75%. That's still an awesome statistic. So 6% for both Google and Amazon. Netflix has more of a range, but they give you more credit. Okay, and 9 out of 16 moves less than 8%. So there's our target for Netflix. That's only 56%, but you'll see I actually ran through and show you all the trades, and we actually did quite well on Netflix, even though our range only showed 56%, that it contained about 56%. Here is the Netflix, and you can see that we had 10 out of 16 when we set Netflix at an 8% move. Okay, once again, we had the price, and then this is set at 8% below and 8% above, and then I set up my bull put and bear call accordingly. Didn't have quite as much profit as I had on Google, but still 10 out of 16 correct. Let's take a look at Tesla. Tesla, the average move is pretty big, 8.2%. And its range is the biggest of anybody's, from 0 to 17.2. But if I trade at or less than 9.1%, I got 69% contained within that price range. Chipotle Mexican Grill average moves about 7.8%. And one of the problems is one of these, let's see, when did that occur? There it is. in April of 18, it went up 32%. I think it went from $300 up to 420 or something like that in a day. It was like unbelievable. A huge move. So it kind of skews this a little bit. But still, if I look at being less than or equal to about 7.4%, I get 12 out of 16 or 75%. And these are the target numbers that I use to set up my bear call and bull puts. And if I do that, I just put the trade on the day before. Actually, if let's say Google is going to have earnings after the close on a Tuesday. Let's say it's going to be on a Wednesday. Say it's on a Wednesday. So what I want to do is on the close on Monday is I want to set this up. Okay. Or actually the close 2 days before earnings, which only takes an effect the next day. Okay. And then I want, if it goes above there, I want to close it the very next day after earnings, or let it go if it looks like I'm well within the price range and I can watch it accordingly. Apple moves 4.3%, and it's pretty tight. Once again, it's very similar to Google and Amazon, with 12 out of 16 dates moving less than 6% or 75%. All these are awesome statistics. So here's kind of a summary. It's a list of the higher price stocks with the decent open interest. We have Alphabet, Google, and what I do is I set up my Iron Condor at 5.5%, getting 11 out of 16 correct. Amazon, I set it up for less than 6%, it gives me 12 out of 16. Chipotle, less than or equal to 7.4%. Netflix, less than 8%. Tesla, less than 9.1. Apple, less than 6. Now, once you know these, first of all, you only need to trade these 6 in earnings. They are big boys. They're going to bring in a nice profit. You don't have to trade shotgun and trade everything that's out there. You can just focus on these 6. I've scoured these and I've traded these for a long time. They have bigger credits and high open interest that give you the liquidity. These are the very best to trade. Just focus on this small number. Focus on these 6. The rules then are like this. You only want to trade the high price stocks, the 6 that we talked about. You want to set up an Iron Condor 2 days before the earnings, as close to the close as possible. You're going to sell an out of the money bull put, which is selling a price equal to the average move, and buy 10 strike prices above further out of the money. At the same time, I want to sell an out of the money bear call, where I sell at a price equal to the average move. Remember the average moves that I showed you back here. That's what you're going to use. And you want to buy 10 strikes further out of the money. You want to buy the number of contracts based on your trade size. And I'm going to show you that chart that I showed you previously about the realistic expectations. And you can kind of determine how many contracts you want to trade versus your portfolio. And like I said, if the earnings have a greater than average move, exit immediately the next day. If the earnings have less than the average move, you might consider staying in. You might even consider staying until expiration and grabbing everything you can. Now remember, the credit of the trade is the combination of the bull put and the bear call, and we have the 6 high price stocks that give us good credit. Now let's take a look at that chart again, showing the realistic expectations. And remember, it's the profitable percent times reward minus the losing percent times the risk. And what I've done here is I've taken a trade size of $50,000 with, excuse me, a trading account size of $50,000 with the trade size of only 10 per trade, if you will. Okay. Now, for an iron condor, for the 6 stocks that I'm talking about, it will cost you $1,000 margin minus the credit to set up the trade. So if your trade size is, if you're only going with one contract, your trade size is only $1,000, you can get into this game for only $5,000. Maybe even less if you want to cut down the number of trades you make. Okay. And remember, the expected returns are going to be 87% return on versus the 15.2% for the SPY for 2019. This is a statistical way of looking at realistic expectations. I need to tell you at this point in time that past performances is no guarantee for future results. There will be losers. There will be losing streaks. So if you want to stay in this game and take advantage of the winning strategy, you want to keep your trade size to the point where you're not feeling anxious over the trade. In other words, if you have a trading account size of $5,000, don't go in and put all $5,000 on one trade, because what happens if you lose it? And then all of a sudden it's like, oh man, that didn't work. No, it's not going to work all the time. You have to be smart about how big of an account you've got, how much you're willing to put on the trading during earnings, and then determine your trade size accordingly in the number of contracts that you will do. I hope you enjoyed this video. What I'd like you to do now is click on this thumbnail to learn how to profit in any market trading credit spreads. I have a 12-part series that talks about how I trade during the year other than earnings using credit spreads, and I think it's very informative. I hope you enjoy it. Just go ahead and click on the thumbnail. Also, if you'd like to subscribe to my channel, please also do that. Again, I hope you enjoyed this video. Good luck to you. Bye-bye now.